Internal Revenue Service IRS tax news. Here's why some people's economic impact payment is different than expected. COVID tax tip 2020-59 May 20, 2020. As people across the country receive their economic impact payments, some might receive a different amount than they expected. Eligible individuals receive a payment for $1,200. Two eligible individuals filing a joint return receive $2,400, and eligible individuals receive up to an additional $500 for each qualifying child who meets the conditions outlined on the qualified child requirements page. There's a link to the qualifying child page here. There'll be a link to this in the description. So the general rule is basically, if you're a normal tax filer, normal conditions, they're going to be sending out the check, the automatic check, based on basically just being a tax filer, that being the $1,200. So that's going to be the general baseline that you will have for the economic impact payment. Now, if you're married, then you have basically two social security numbers in general, not including any dependents at that time. So you would think then the payment would be twice that, $2,400. So single $1,200, married $2,400. Now there could be some kind of conditions where the IRS doesn't know you're married or something like that, but they might have your social security number through some other type of payment. Say you didn't file a tax return, for example, and they know that you have social security payments or something like that. Then they may still give you the payment of $1,200 even though you're not married. You would think that they would still just send out the normal $1,200, and they might send that as if two individuals were single, right? The two individuals might get the $1,200, which should still be basically okay in that situation because it will add up to the $2,400 if married. But if you file a tax return that indicates and shows the IRS that you're married, you would think that you'd get the payment of $2,400. Then you've got the qualifying child, and that's where the kind of confusion often lies with regards to how much you're going to get paid, because there's a difference between someone being a dependent on the tax return and a qualifying child. So the qualifying child for the extra $500 is a little more stringent, and this is a little confusing because again they're sending a check out to almost everyone with a social security number, it seems like. However, if you're not on your own tax return, in other words, if you're claimed as a dependent on someone else's tax return, then you won't be receiving the $1,200 most likely, right? Then the question is whether or not the person who claims you as a dependent is going to get the extra $500 for the dependent, and that would only be the case if you're a qualifying child, if you qualify for a qualifying child. So, and that would mean, amongst other things in general, you got to be under basically 17 for that to be the case. So if you're being claimed as a dependent, or if you're claiming someone else as a dependent who is over 17, like possibly a parent or someone that's a child that's going to college or something, that's often where the confusion lies. Now note that these credits are basically based on, they're a pre-credit that's based on kind of like 2020 numbers. So you could then file your 2020 return, and someone who was a dependent last year, say a parent or a child that was going to college, may for whatever reason not be a dependent, might not be claimed as a dependent on the tax return for 2020, and at which time then they may qualify. So if someone, for example, was a dependent on the tax return for 2019, then it could be that they didn't get the $1,200 and you didn't get the $500 because they're over 17. However, if you then file your tax returns for 2020, and at that point they're not a dependent for whatever reason, right? They file their own tax return. You're not claiming them as a dependent, and then you would think then that they may now then qualify for the $1,200, considering they're not filing as a dependent for the year on which the actual payments are supposed to be based, which is 2020. So the payments are going out basically on an assumption on the information that the IRS has from 2019 or 2018 or some other resource. When you file the 2020 return, the idea is that that's when all these kind of possible problems will reconcile themselves, and any differences will take place. And obviously, given that being the case, people may do some tax planning, and before 2020, and people that might have been a dependent in 2019 may not qualify, may not be claimed as a dependent in 2020. You think that could be a result of it. Anyway, back to the text. The economic impact payment is automatic for eligible people who filed a tax return in 2018 or 2019. They're also automatic for those who aren't required to file a tax return, but who receive Social Security retirement, survivor or disability benefits, railroad retirement benefits, supplemental security income, veteran affairs benefits. So the idea of the IRS sending these out, of course, is to send them out as quickly as possible. They said, hey, we're even though we're kind of basing this credit on 2020 information, we want to send the money out now. That's the point. Therefore, we're going to send it out based on what we have in order of priority, what the most reliable information we have, that being 2019, if they have it. Many people haven't filed 2019 yet, so they extended the deadline. So 2018, then, if they have that, if they don't have either of those, that information, then they're going to be going to these other resources saying, hey, did any government agency make payments to individuals that didn't file a tax return? Because if they did, maybe we can use that to process a payment and use the same source to process the payment and give out that information. Now, again, you can see that we're talking about 2020 tax return that we would like to base this thing on, and they're basing it on 2019, which isn't gonna be perfect, but hopefully, considering the credit's pretty basic calculation, everything will basically be right. But if there's a dependent on 2019 that's not a dependent in 2020 or vice versa, then there could be a difference or a change, which the IRS wouldn't know about until the 2020 tax return was filed. Once done, they might then make that change. 2018, it's even a little bit more likely that could be the case, right? Maybe their child was born, during that time period between 2018 to 2020. Or a child is no longer a dependent that's going to college or something like that, could happen. And that means that those kind of differences would result in a payment that might not be what would be expected, that may be reconcilable once the 2020 tax return is filed. And that is going to be more the case, of course, if we go back to other things, if we don't even have the tax return, and they're basing their information on Social Security payments or supplemental security income, then all they know is that there's some individual that didn't file a tax return that's getting benefits in some other way, and they're just going to basically send out a payment. So they're not going to know if the person's married. They're not going to, most likely, right? You can imagine that they're just going to send out the $1,200 payment. So again, if that's wrong for whatever reason, you would think then the way that they're planning to reconcile those kind of differences is just to send out the payment to get the money out as fast as possible, and then file the 2020 tax return, which is what the actual credit is supposed to be based on at the end of the day, but we don't know about that until 2020 is over. Then once they file the 2020, hopefully reconciling any differences, giving out any added payments that are needed, at that point in time for any, misadjustments that were based on prior years or other information, and hopefully not ending up in situations where the credit, if payments... The idea would be that if the payment was too low, then hopefully you're going to get the difference in 2020 when you file the tax return. But then there's a question of what if the payment was too high? What if you sent a check out to somebody that you shouldn't have sent that much out to? Is it going to be reduced? And there's kind of that's more of a gray area. I'm not totally sure. But the idea is if you're underpaid, then hopefully reconciling that when you file the tax return 2020. Back to the text. People who receive less than expected can go to the irs.gov, that's irs.gov, and receive this chart PDF. So there's a PDF here, link here. There'll be a link to this in the description to check the payment they should receive. It has examples that use filing status and income to calculate the payment amount. So you can look at this chart and you can say, and it should be fairly basic, right? The chart to think about, because there's not a lot of factors to figure out what this payment is going to be. There is a phase out, an income limitation phase out, and then it's based on the individuals, and then the qualifying dependents qualifying for the credit, child dependents. Let's take a look at this chart real quick here. We got with no qualifying children. So if you're in the top section, have no qualifying children, then the status married filing joint. If you have income from 0 to 150,000 and you're married, right? So you got incomes from 0 to 150,000, then you get the credit of 2,400, which would be twice the individual. So you can think of, you have two social security numbers, you're not hitting the cap of the income limitation, therefore you're going to get twice that, or the 2,400. married filing joint that has income above 150,000. So if your income is above 150,000, then it's going to start to phase out, 5% phase out. And that phase out stops at 198,000. So at which point in time you would think that you would no longer get anything because of the income limitation phase out. So for example, if your AGI is 170,000, then you're in that middle range where you got that phase out because of the income being high. You are 20,000 above the 150,000. Therefore, your EIP will be reduced by 1,000, 20,000 times 5%. Your economic impact payment would then be 1,400. So then if we have the head of household then, so head of household status typically being, you're single, you're not filing as married, and you typically have a dependent in that situation. So then your head of household from 0 to 112,500. That means that you're going to get the 1,200, the standard payment. So again, you think about it like this: you're going to get the standard 1,200 per person, per social security number, not including the dependents, really, the individual, the married individual, unless you hit the phase out. And so if you're head of household under the phase out of 112,500 of income, you're going to get that $1,200. If you're head of household filing status and you have income over 112,501 but not over 136,500, that means that you're going to get some of the payment, but it's going to start to phase out due to the income limitation. There's a 5% phase out. If you're over the 136,500 and file head of household, basically single with a dependent, right? Often, that's the general kind of rules. Then you're not going to get any of it because you're over the income limitation at that point. So the confusing point is when you're in between that phase out period. For example, if your AGI is 125,000, you are 12,500 above the 112,500. Therefore, your earned income payment will be reduced by 625, 12,500 times 5%. Your earned income payment would be 575. All right. And then all others. So basically now if we're thinking like single, filing status, for example, would be the largest other group here. 0 to 75,000, you would have the 1,200. So again, same kind of idea here that, if you have one social security number, you're single now, you're filing single, that means you're going to get the standard 1,200 unless you hit the income limitation now being smaller or lower due to the fact that you're filing single instead of head of household, it being at the 75,000. So it starts to phase out after you have over 75,000 of income, 75,000 up to 99,000. After you get to 99,000, you're not going to get any more of the payment. There's a 5% phase out. So for example, if your AGI is 84,000, you are 9,000 above the 75,000. Therefore, your earned income payment will be reduced by 450. 9,000 times 5%, your earned income payment would be 750. Now, if you look at that payment, if you calculate your payment, you think it's wrong, then you want to determine, okay, what's the thing that's wrong about it, and then think about how you can change that, how you can adjust that. I mean, you could think, oh, was the income different in 2018, the year they based it on, versus 2020, which is the year that credit's going to be based on? Was there a difference, or in 2019, is there a difference in dependents? And so on. So let's go into this, back to the text. Here are some common things that help explain what may have happened. The taxpayer hasn't filed a 2019 tax return, and their payment was based on 2018 tax return. This could also be the case if the IRS has not finished processing the 2019 return. So you might say, hey, look, I've got the information. My income phase out was below the threshold for 2019. But even if you filed the 2019 return and the IRS said, hey, we got it, it could be the case that they haven't processed it yet, and therefore they based the payment on 2018 because this is a speed-related thing. They said, I'd rather get the payment out now than make sure everything's perfect. So they just said, we haven't processed 2019. We're going to base it on 2018. If your income, for example, was higher in 2018 than 2019, then you may have been subject to a phase-out, which was not correct based on the 2019 information. Back to the text. The qualifying child, there's a link to qualifying child here, is not under the age of 17. For purposes of the payment, the child's age is how old they are at the end of the year for the tax return on which the IRS bases the payment amount. If a dependent is 17 or older, they don't qualify for the additional $500. This includes a parent or other relative and college students. So you might say the typical kind of thing is like, well, they're still a dependent because they're going to college and whatnot. So you would think that if I'm claiming them as a dependent, you would kind of think that someone would get some kind of benefit for almost anybody with a social security number. You would kind of think, So you would think that if they're still being claimed as a dependent, you would think you'd get the $500, but that's not the case because it's qualifying child, meaning under 17. So you got to be under the 17 in order to get that. So in those cases, because they didn't file the tax return themselves in such a way that they're claiming themselves, because they can be claimed by a dependent as another, they are not getting a payment themselves. They're not getting the $1,200, and the parent is not getting the payment of the $500 due to the dependent. Back to the text. The economic impact payment was offset by past due child support. While this is the only offset that can affect the payment amount, federal law allows creditors to garnish a payment once it's deposited into the bank account. So you might say, well, what else could have, what else happened here? Well, if there was child support, then it could be possible that they lower the payment due to the past due child support. And if they put the money into your bank account and there's some other garnishment, in other words, there's some problem happened and the bank is actually required to take the money directly out of the bank account, well, then it could be subject to a garnishment as well. Back to the text. In many instances, eligible taxpayers who received a payment that was smaller than expected may get an additional amount early next year when they file their 2020 federal tax return. So that's going to be and again, I think this is kind of the idea from the IRS, right? The IRS is saying, hey, look, I'm going to base this thing on whatever we got. That means 2019 would be the best. If not, 2018. If not, we'll go to any kind of other information we have. We're going to shoot those payments out as quick as possible, and then we will rectify any problems when you file the 2020 tax return. Back to the text. Anyone with questions about the payment can visit Economic Impact Payment Information Center. There's a link to that here. It has answers to questions about eligibility, payment amounts, what to expect, and when to expect it.